This is the most asked question in Canadian finance, and the answer isn't what most people think. I'll give you the exact income thresholds to decide. Welcome back to the channel, where we equip Canadians with the knowledge to build lasting wealth. Today, we're tackling the perennial debate, RRSP or TFSA for 2026. This decision, often simplified, is actually nuanced and depends heavily on your individual financial situation and goals. Choosing wisely can literally mean tens or even hundreds of thousands of dollars more in your pocket over your lifetime. Let's dive deep to ensure you make the most informed choice for your future. Making the right choice between an RRSP and a TFSA isn't just about saving money, it's about optimizing your entire financial journey. Your decision today can have a profound impact on your investment growth, your tax bill, and ultimately, your financial independence decades down the line. It influences how much you pay in taxes now, how much your investments grow, and how much you can withdraw tax-free later. This isn't a one-size-fits-all answer, and understanding the nuances is what separates good financial planning from truly exceptional wealth building. Let's lay the groundwork for understanding each account. Let's begin with the Registered Retirement Savings Plan, or RRSP. At its heart, an RRSP is designed to help you save for retirement by offering significant tax advantages. When you contribute to an RRSP, those contributions are tax-deductible, meaning they reduce your taxable income in the year you contribute. This often results in a tax refund, which can then be reinvested. Critically, any investments held within your RRSP grow tax-deferred, meaning you don't pay taxes on capital gains, dividends, or interest until you withdraw the money, typically in retirement. This deferral allows your money to compound more aggressively over time. The immediate tax deduction is one of the most attractive features of an RRSP. If you're in a higher tax bracket now, contributing to an RRSP effectively allows you to pay less tax today. You receive a refund that can be a powerful tool for further investment. Furthermore, the tax-deferred growth within the RRSP is a compounding superpower. Imagine your investments growing year after year without being eroded by annual taxes on gains. This accelerated growth truly adds up over decades. The ideal scenario is contributing when your marginal tax rate is high and withdrawing when it's lower in retirement, effectively shifting income to a more tax-efficient period. While powerful, RRSPs come with certain considerations. The most significant is that all withdrawals from an RRSP, with a few specific exceptions, are treated as taxable income in the year they are taken out. This means if you withdraw money before retirement, you'll not only pay income tax but also face a withholding tax, which the government holds back immediately. Moreover, substantial RRSP withdrawals in retirement could potentially push you into a higher tax bracket than anticipated, or impact income-tested government benefits like Old Age Security, OAS, and the Guaranteed Income Supplement, GIS. Careful planning is essential to ensure withdrawals align with your overall retirement income strategy. Beyond just retirement savings, RRSPs offer unique programs that provide flexibility for significant life events. The Home Buyer's Plan, or HBP, allows you to withdraw up to $35,000 from your RRSP, tax-free, to purchase or build a qualifying home. This is an interest-free loan to yourself that you must repay to your RRSP over 15 years. Similarly, the Lifelong Learning Plan, or LLP, permits tax-free withdrawals to finance full-time education or training for yourself or your spouse. These programs are exceptions to the general rule of taxable withdrawals, offering valuable financial support for specific goals, provided you meet the repayment conditions. Understanding your contribution room is vital for RRSPs. For 2026, your RRSP contribution limit will be 18% of your earned income from the previous year, specifically 2025, up to a maximum dollar amount. The maximum RRSP contribution limit for 2026 is confirmed to be $33,810. This figure is indexed annually. Importantly, any unused RRSP contribution room from previous years carries forward indefinitely, accumulating over time. You can find your exact personal contribution room on your notice of assessment from the CRA or by logging into your My Account online. Remember to account for any pension adjustments if you participate in a company pension plan, as these reduce your available RRSP room. Now, let's turn our attention to the Tax-Free Savings Account, or TFSA. This account is arguably one of the most powerful savings vehicles introduced in Canada. Unlike an RRSP, contributions to a TFSA are made with money you've already paid tax on, your after-tax income. The magic, however, happens inside the account. All investment income, whether it's interest, dividends, or capital gains, grows completely tax-free. And here's the best part: when you withdraw money from your TFSA, for any reason, those withdrawals are also 100% tax-free. This makes the TFSA incredibly versatile, suitable for both short-term savings and long-term wealth building. The flexibility of the TFSA cannot be overstated. Since withdrawals are tax-free, you can use the money for any purpose without penalty, whether it's a down payment on a home, a new car, a dream vacation, or supplementing your retirement income. Crucially, TFSA withdrawals do not count as income for tax purposes, meaning they will not affect your eligibility for income-tested government benefits like Old Age Security, the Guaranteed Income Supplement, or the Canada Child Benefit. This makes the TFSA an exceptional tool for those who anticipate needing income in retirement but want to protect their government benefits, or for younger families optimizing for child benefits. It truly offers unparalleled control over your finances. While incredibly versatile, the TFSA also has a few important limitations. The primary one is that there is no upfront tax deduction for contributions, as you're using after-tax dollars. For some, especially high-income earners, this can be a deterrent compared to the immediate tax savings of an RRSP. More critically, the contribution rules are strictly enforced. Exceeding your TFSA contribution room can lead to a penalty tax of 1% per month on the excess amount. It's also important to remember that while withdrawals replenish your contribution room, that room is only restored at the beginning of the next calendar year. So, if you withdraw funds mid-year, you can't recontribute them until January 1st of the following year without risking an overcontribution. Similar to RRSPs, TFSAs have annual contribution limits. The TFSA limit is indexed to inflation, typically rounded to the nearest $500. The annual TFSA contribution limit for 2026 is confirmed to be $7,000. For individuals who have been eligible since the TFSA's inception in 2009 and have never contributed, their cumulative contribution room for 2026 is a massive $109,000. Remember, if you withdraw funds from your TFSA, that exact amount of room is added back to your available contribution room, but not until January 1st of the following year. Always double-check your current contribution room with the CRA through your My Account to avoid any penalties. To summarize the core differences, let's look at them side by side. With an RRSP, contributions are tax-deductible, reducing your current taxable income, but withdrawals are fully taxable in retirement. It's essentially a tax deferral strategy. The TFSA, on the other hand, involves after-tax contributions, meaning no immediate tax break, but all growth and withdrawals are completely tax-free, forever. This makes the TFSA incredibly flexible for any financial goal, while the RRSP is primarily designed for retirement. Furthermore, TFSA withdrawals have no impact on income-tested government benefits, a crucial advantage that RRSP withdrawals do not share. These fundamental distinctions form the basis for deciding which account suits you best. This is where we get to the heart of the matter: your income and marginal tax bracket. The fundamental principle for choosing between an RRSP and a TFSA hinges on comparing your marginal tax rate when you contribute versus your anticipated marginal tax rate when you withdraw. If you are currently in a high marginal tax bracket, an RRSP contribution provides a significant tax deduction, saving you more tax today. The ideal scenario is that you'll be in a lower tax bracket in retirement when you eventually withdraw those funds. Conversely, if you are in a lower tax bracket now, the immediate tax benefit of an RRSP is less substantial. In such cases, a TFSA might be more advantageous, ensuring all future growth and withdrawals are completely tax-free, regardless of your future income level. This income tipping point is what most people miss. If you are a high-income earner, generally meaning you are in one of the higher marginal tax brackets, prioritizing your RRSP contributions is typically the optimal strategy. By contributing to an RRSP, you immediately reduce your taxable income, potentially moving into a lower tax bracket and generating a significant tax refund. This refund can then be reinvested, further boosting your savings. The expectation is that in retirement, your income will be lower, placing you in a lower tax bracket, so you'll pay less tax on your withdrawals than you saved on your contributions. This strategy allows you to defer a substantial portion of your tax liability and leverage compounded growth to build a much larger retirement fund. For individuals in lower to middle income brackets, or those just starting their careers, prioritizing the TFSA often makes more financial sense. The tax deduction offered by an RRSP provides less immediate benefit when your marginal tax rate is already low. With a TFSA, all your investment growth and withdrawals are completely tax-free, which is a powerful advantage regardless of your income level. It provides unmatched flexibility for short-term goals like a home down payment or long-term goals like retirement, without impacting eligibility for income-tested government benefits. By maximizing your TFSA first, you're building a highly liquid, tax-free reservoir of wealth that you can access whenever needed, without future tax implications or penalties. Your specific financial goals should heavily influence your RRSP versus TFSA decision. For short-term goals, such as saving for a new car, a vacation, or an emergency fund, the TFSA is unequivocally the better choice due to its tax-free and penalty-free withdrawals. If your primary goal is long-term retirement savings and you are a higher income earner, the RRSP's tax deferral and deduction benefits often make it superior. For a first-time home purchase, consider the RRSP's home buyer's plan, but compare it against simply saving in your TFSA. The TFSA provides more flexibility if you decide not to buy or need the funds for something else. Always align the account's features with your intended purpose. One of the most powerful, yet often overlooked, advantages of the TFSA is its impact on government benefits. TFSA withdrawals are explicitly not considered taxable income by the CRA. This means they will not affect your eligibility for income-tested benefits like the Old Age Security, OAS, the Guaranteed Income Supplement, GIS, or even the Canada Child Benefit, CCB, for younger families. In contrast, RRSP withdrawals, when converted to RRIF income in retirement, are fully taxable and do count towards your net income, which can lead to clawbacks of benefits like OAS and GIS. For those anticipating lower retirement incomes or relying on government support, maximizing your TFSA is a crucial strategy to protect these vital benefits. Ultimately, for many Canadians, the optimal strategy isn't about choosing one over the other, but rather strategically utilizing both the RRSP and the TFSA. The accounts are complementary tools, each excelling in different scenarios. You might start by maximizing your TFSA early in your career when your income is lower. As your income grows and you move into higher tax brackets, you can then prioritize RRSP contributions to leverage those valuable tax deductions. Some even implement a TFSA first, then RRSP, then back to TFSA strategy as income and retirement needs evolve. The goal is to maximize all available tax-advantaged contribution room, creating a robust and flexible financial plan that adapts to your life's changing circumstances. To put this knowledge into action for 2026, here's your personalized action plan. First, carefully assess your current income and consider your income trajectory for the next few years. Are you expecting significant raises or changes in your employment? Second, clearly define your short-term and long-term financial goals. Are you saving for a house, retirement, or something else? Third, verify your exact RRSP and TFSA contribution room directly through your CRA My Account to avoid any penalties. Finally, if you have complex financial situations or simply want a personalized roadmap, consider consulting a qualified, fee-only financial advisor. They can help you tailor these strategies to your unique circumstances and ensure you're on the optimal path. We've covered a lot of ground today, comparing the RRSP and TFSA for 2026. Remember, the RRSP is your powerhouse for tax deferral, best utilized when contributing at high tax rates and withdrawing at lower ones. The TFSA offers unparalleled tax-free growth and withdrawals, ideal for flexibility and protecting government benefits, especially for those in lower tax brackets. Your personal income situation and financial goals are the ultimate guides in this decision. Don't be paralyzed by choice, analyze your situation, leverage the information provided, and make an informed decision. The most important thing is to start investing and make the most of every dollar you save. Thank you for joining us on this journey to financial optimization. Subscribe for more Canadian finance insights. Thank you for watching. If you liked this video, please like and subscribe.